Yeah, welcome to Dicalo Consulting. At this moment, we'll be discussing the P2P cycles from when the purchases are raised within an organization right up to when payments are processed to third parties and the various activities at the level of each stage. The very first thing is in an organization or within an individual is that whenever you want to make a purchase decision, you will need to identify whether you have that particular item available or whether you need to procure it. From a corporate or organizational point of view, if any division or any department within an organization is in need of any material or in need of inventory, they will need to make a material requisition form which is sent to the warehouse or the inventory department, and this material requisition form must be approved. If we assume that this material requisition form has been approved by the party involved or the divisional head of the respective division, and then the warehouse realizes that this material is not available in stores, it means that they will need to furnish this requisition to the procurement department to place an order. Now, basically, what happens practically is that once this requisition has been approved and the inventory is not available in the stores, which means that the party requesting for the material has actually raised the requisition, and then it has been approved, and then the inventory or the respective item which is requested is not available in the warehouse. The next phase of it is that it will be forwarded to the procurement department. Now you understand that the role of the procurement department will be there to source materials or inventory with third parties. The very first thing that the purchasing department will do is that they will need to raise what we call a letter of inquiry or a status inquiry, where they will be writing to third parties upon receiving this approved requisition. They will then write to third parties or suppliers who actually can supply them with this material or dealers of this particular material, and they'll be writing what we call a letter of inquiry, trying to inquire more about the various goods and services which are being sold by the third parties or offered by the business, by the suppliers, and their conditions of sales. Now, once the procurement department has raised this letter of inquiry, which equally must be approved by the procurement manager, they will receive a response to this letter of inquiry from the suppliers by submitting what we call quotations. Quotations will be submitted by suppliers incorporating the various goods and services which they have available, the terms and conditions of sales. Now, from these quotations, the procurement department will receive these quotations from these vendors. Upon receiving these quotations from these vendors, they will need to analyze the quotations, and this analysis will be based on looking at the quantity and the prices available and their conditions of sale, and then from there they will be able to choose the best quotation. And once they have chosen or selected the best quotation, they will then raise what we call an LPO, which is what we call purchase order. Once this purchase order has been raised or created within the organization, it will equally need to be approved. These are internal controls, these are control measures which are put in place within the organization to make sure that all purchases that are raised are authorized. So basically, once this purchase order is raised, it will be approved by the procurement manager, or maybe as well as the divisional manager or the finance manager, depending on the internal control systems that have been put in place within the organization. In most companies, the procurement manager will need to approve the each purchase order, the divisional manager, as well as the finance director or controller, depending on the situation within the organization. In most cases, they equally have their limits, which means that above a certain limit, maybe the finance is supposed to approve, or above a certain limit, only the procurement manager should approve things like that. So this is very important. These approvals are very important. Now, once they have actually raised this purchase order, or this local purchase order, and it has been approved internally within the organization, then now this purchase order or LPO will be sent to the customer. Now this purchase order in most circumstances like a legal document, because the company is actually now requesting the supplier to supply to them a given quantity of a given product or products at specified prices, and taking into account the terms and conditions which we actually received from the quotation. So once this approved PO LPO has been forwarded to the supplier's role now or responsibility is to supply the goods to the organization. Now, once the organization receives these goods, in most big multinationals, these goods will be received by what we call by the warehouse. And prior to these goods being received in the warehouse, in some organizations, they have what we call the goods received department. And the role or responsibility of this goods received department is to ensure that all goods are received from third parties, and that all goods received from suppliers are in good condition, and that the goods actually relate to the organization. And the more reason why most organizations always request suppliers to make sure that when they're coming to supply goods to them, they should always come along with their LPO, which means that the LPO which was actually sent to them by our organization, the delivery truck driver from the supplier should come along with this LPO, or the purchase order. The main reason of them coming along with this purchase order or the LPO, even if they're not coming along with it, they should mention the LPO number or PO number, is for the receiving organization to be able to cross-check and confirm that the goods which are being delivered are actually goods that were ordered by them or things like that, because all organizations, they have their systems, and upon entering the PO or LPO number in their system, they will be able to understand whether the goods were actually ordered by them or not. So basically, upon receiving the goods, or the goods receiving section of the company will actually cross check these goods, the quantity, the prices, making sure that all the prices which have been incorporated or stated in the invoice are in confirmation with what was actually stated in the LPO or the PO. Once these goods are okay, the role of the goods received department is to prepare what called a goods received note. This goods received note is simply detailing the goods which you actually received and their conditions in which they were actually received, the prices as well as the value, and basically assuming that everything is in conformity, that all the invoices were billed as per the quotations and the LPO. It means that the value of the goods in the goods received note, the quantity and the prices should match. Now, if we assume that maybe some of the goods are not in good conditions or things like that, it puts that maybe the goods are not in good condition, or they are supply goods which are actually not what the supplier actually requested, it means that the goods may be returned back to the supplier. And in this situation, the supplier, the organization, the good receipt department will also call a purchase retains, and the supplier will be requested to issue a credit note to the receiving organization. Now, once this good receipt note has been received, it will be forwarded to the accounts department. Now, this is when now we come what we call accounts payable. You understand that accounts payable will only arise in circumstances where goods have been purchased from the supplier on credit, which means that we have actually purchased the goods from the supplier, but we have not processed payment for these goods, which means that we receive the goods and then we initiate payment subsequently, depending on the credit period which we have agreed with their supplier. It may be 30 days, it may be 60 days, it may be 90 days, it may be 120 days. It will normally depend on the conditions or the terms and conditions which have been agreed by the buying organization and the selling organization. So basically, once this good receipt note have been received, it's forwarded to the accounting department. Okay, if we assume that we are dealing with a company that's a WMS, or they have a well structured um warehouse management system, it means that once these goods are received in the by the receiving department, they are going to raise this good receipt note. It will be sent in the system to the warehouse. Once the warehouse receives these goods physically, they will cross check, and after cross checking these goods physically and they realize that the goods are in conformity with what has been sent to them in the system via the good receipt note, they will then approve in the system that they have received these goods. Now, once they approve that they have actually received these goods, the second phase of it is that they will equally validate from their side, and this good receipt note will be sent to the accounts department. Now, the role of the accounts department is to make sure that payments are processed to suppliers when the invoices are due. Now, which means that once we have received this consignment from the third parties, we should make sure that we should process payments to suppliers on the due date of the invoices. We must not keep the invoices pending until the supplier comes on chasing for payment before we should process their payments. It is our responsibility to make sure that all payments are processed in favor of the supplier when they are due as per the terms and conditions that were accepted by both parties. Now, at the level of these payments, our accounts payable now, once these invoices are booked in our system, in order to make it easier, the role of the accounts payable accountant now is to make sure that all payments are made to the supplier. And in most circumstances, all the accounts payable team members or accounts payable accountants are expected to ensure that they conduct what we call a supplier reconciliation. Why are they conducting a supplier reconciliation? It is essential that on a routine basis, before the accounts payable accountant processes any payment to the supplier, they should request from the supplier their statement of accounts. Once they get their supplier statement of accounts, they equally generate the entity statement of accounts, and they should conduct what we call a reconciliation process. Once they conduct this reconciliation process, the accounts payable accountant should be able to raise payment for all invoices which are reflecting in both the books of the entity and the books of the supplier, and which are equally falling due during that period. For instance, even if the invoices are reflecting in the statement of accounts of the supplier and in our books, and we realize that these invoices are not yet due, the accounts payable accountant is not supposed to process payment for these invoices. So the first thing, the responsibility of an accounts payable accountant is conducting this accounts reconciliation, which is payables account reconciliation, and raising payment for all due invoices. Once payment has been raised for these due invoices, the next step is that in most circumstances you realize that the balances of the suppliers will be different with the balances in the books of the entity. So the responsibility of the accounts payable accountant is to make sure that after reconciling and requesting a payment for the invoices which were actually due and which have already been booked in our books and are reflecting in the books of the supplier, the next step is what? Identify, investigate any reasons for the discrepancies in the books of the entity and the books of the supplier. We are taking an example where the supplier is showing that we are owing them $20 million, and then we realize that in our books it shows that we are owing the supplier $15 million. It means that there's a discrepancy between the books of the supplier and our books of how much? 5 million. The role of the accounts payable accountant is to investigate possible reasons as to why this difference of 5 million is arising. Maybe this we have already processed this payment to the supplier, and the supplier has not yet received the cash because the funds are still in transit, which is cash in transit. Or maybe the supplier has already sent these goods to us, but the goods have not yet been received in the warehouse. Or the goods have already been received by the warehouse, but a good receipt note has not yet been raised, or the goods have not yet been uploaded in the system where the case is. So it is the responsibility of the accounts payable team now to follow up and make sure that all these balances in our books actually agree with that of the supplier. Now you understand that once the accounts payable accountant raises this payment for invoices which are reflected in our books and are due for payment, the next thing is that the Treasury Department will need to get all the necessary approvals. Best practice on accounts payable management requires that after this accounts payable accountant has raised a payment request, there should be a third party, or there should be a team leader, or there should be another individual within the organization to review these reconciliations, to review these payments which have been raised by the accounts payable accountant, and validate if the payments are okay in accordance with the company policy or not. So we are saying that once the accounts payable accountant has already raised a payment request, the payment should or request should be reviewed by his or her team leader and validate whether it is correct or not. And once the validation is done from there, the Treasury Department can now raise a payment, the payment now with the bank. And once they have raised the payment with the bank, after getting all necessary approvals from the division or from the senior managers who have approved the payment, from the, after the payment run equally has been run within the system, they can then release the payment from the bank. Now once the payment is released from the bank, it is equally the role of the cash or treasury department to carry out what we call what a bank reconciliation, to make sure that at the end of the period, all transactions which are reflecting in the cash book are equally reflecting in the books of the bank or things like that. And basically you understand that the role of the accounts payable is equally to book what we call fixed asset. You understand that fixed assets or non-current assets in accordance with International Accounting Standard 16 PPE are assets which are actually acquired with the purpose of being used in generating future economic benefits. So basically, fixed assets will be booked. Invoices for fixed assets will be booked by the accounts payable accountant. Now, this will be done only when the accounts payable accountant has taken coding from the respective divisional heads. They're going to advise on the business unit and the GL to be used in making this booking. So while the accounts payable accountant does this booking of the fixed asset, he has to work in collaboration with the TB holder or the GL accountant of that particular entity, so as to ensure that the asset is actually tagged in the system, and to make sure that the GL accountant is entitled to recognize the fact that that asset is supposed to be what subject to depreciation. So the the accounts payable accountant will actually book this fixed asset invoice in the system and tag it in the system, and should do this in conjunction or in collaboration with the GL accountant, so as to ensure that at the end of the day this asset will be subject to what depreciation, because you understand that non-current assets are assets which are used in generating future economic benefits, and they are subject to depreciation. So basically, in a nutshell, in order to smoothly manage your accounts payable function with ease, you need to put in place segregation of duties, which will help to ensure that all the payments that are made to suppliers are approved and are authorized by the respective team members. So basically, before any invoice is processed, the three-way matching is always performed, where the accounts payable accountant matches the local purchase order or the purchase order with the invoice copy that has been received from the supplier, together with the good received note. So these three documents must be the same, which means that you will be matching the good received note with the local purchase order or the PO, as well as with the invoice copy which has been received or which has been submitted to us by the supplier. Once these documents are okay, from there you can then prepare and present all these payment requests now to the responsible third party for approval. You understand that in the UAE, most of these invoices, you have to know whether the third party is subject to VAT or not. as per the laws that are issued by the appropriate authority. So you will have to cross-check these invoices and make sure in the UAE that it's a taxable invoice or whether it's not a taxable invoice, and whether this should be processed or not. This is the first section where I was just trying to introduce the P2P cycles, as well as explain to you how the payment cycle operates within any organization. You understand that depending on the size of the organization, a lot of measures or a lot of controls will be taken in order to make sure that payments are done only to the approved parties. In our next video, we'll be explaining to you the various internal controls that are put at the level of small and middle-sized enterprises, as well as in multinational companies, for you to understand how the segregation of duties is being performed in order to ensure that efficiency is improved within the various processes. We understand the fact that the main reason why there will be a lot of segregation of duties is to ensure that the tax of one individual is subject to a critical check by another individual within the process. If you take, for instance, in the prior company which I've worked with it, the functions of the accounts payable were separated from the treasury, separated from the bank reconciliation team, separated from the booking team or matching team, and equally separated from the documents control team, which means that there was a particular individual, there was a team that was responsible for receiving invoices from third parties and logging them in the system. You understand that this is we are in the 21st century, and many companies are automating their processes. So basically what they were doing is that, okay, there's somebody who is actually responsible for receiving this documentation from third parties and logging them in the system, and prior to logging them in the system, the necessary three-way matching must have been done, which means that the document control team is responsible for matching the invoice with the good received note, as well as with the LPO or the PO which has been issued by an organization, and after necessary approvals have been taken on issues like that. And we must understand that there are two different types of invoices that every organization will deal with. They will do what we call goods invoices, as well as what we call service invoices. So you need to understand how goods invoices are accounted for and how payments for service invoices is being done. So in our next lecture on accounts payable, we are going to focus more on the accounts payable cycle, how reconciliations are processed, and how you are expected to resolve all the reconciliation issues that are occurring within an organization. It will equally depend on whether you are working within an organization or within the company, or whether you are working within the accounting department of a company, or whether you are working in a shared service environment. You understand that accounting in a shared service environment is completely different from when you are working in a normal company where you simply may be responsible for accounts payable, where you are dealing and relating with all the stakeholders who are actually involved. You understand that in modern times, in order to save costs and improve efficiency, most organizations or most multinational organizations are now focused on operating shared service, where they simply have a particular accounting team in a given geographical location or in a country which is responsible for managing the accounting function or things like that. So basically, in our next video, we'll focus on how you better understand how to account for accounts payable within a shared service environment, and we'll be treating focus on how you can process payments for both service invoices as well as goods invoices. Thank you once more. Do not hesitate. Make sure you subscribe to our channel so that subsequently you'll be able to have access to our videos on the next video that will be uploaded. And I'm expecting to upload the next video in, let's say, a week or things like that, where I'm going to detail a practical illustration of how you can equally manage your accounts payable within a small organization, within a small and medium-sized enterprise, as well as how this is done in a multinational environment. Remember, I have just put this illustration here so that you understand how the processes operate. But this is a practical illustration, these are things which I have done. These are things which I am doing, and I'm explaining this from a practical point of view. But like I've said, they are. I just wanted to give an introductory part to this, where I incorporated both the purchases cycle, how all the goods are ordered within the system, how requisitions are raised, how requisitions are approved, how quotations, letters of inquiry are raised, how quotations are received and analyzed, and the best one are choosing or things like that. So I'm going to create a separate session for each of these cycles in the P2P cycle, so that I will illustrate and spend more time on it and explain, so that everybody can get to understand a practical illustration of how this operates in the real life situation. I understand that most of you may have gone through it theoretically, but I'm going to give a working session on it, a practical application of it with some examples, so that you'll be able to understand how you can apply this in your day-to-day tax at your job site as an accounts payable accountant. Thank you once more.